Crypto markets reject new highs and pull back ahead of Jackson Hole this week. Put skew returns as protection buyers come in. And Deribit release linear options that settle in USDC. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larker from Options Insight. I've got my man Dave from FRNT. How's it going, man?
I'm very good. Yeah, you?
Yeah, not bad, not bad. I think I'm done with summer holidays now. I've been away a couple of times. So.
I know. I kind of felt like we were in this summer lull and then things sort of kicked off and ETH obviously kind of started pushing higher.
Mate, the market denied your prediction.
I know, yeah.
You got within sniffing distance of the all-time highs in ETH and now we're like 500 points lower.
Yeah, but I think we can bounce back pretty quickly as well on that. But yeah, it's a weird market at the moment.
I'm going to stop you right there.
Yeah.
Before we get into the macro discussion, we do want to talk about Deribit launching linear options on BTC and Ethereum. Now, why don't you ask me the obvious question?
what are linear options?
They're basically options that are like the TradFi markets, right? Because the options on Deribit and Ethereum, not Deribit and Ethereum, Bitcoin and Ethereum have always been inverse options. And they've been a bit funky and a bit hard to get your head around if you're like a TradFi options trader because...
Inverse being the underlying collateral is Bitcoin.
Yeah, so when you buy the option, like you're looking at the strikes, for example, right? And the strikes of the options are in dollars. Is it the 100K strike? Is it the 110K strike or whatever? But when you go and pay the premium, you're actually paying Bitcoin or you're receiving Bitcoin if you sell... You're receiving Bitcoin. So you're receiving 0.0 something Bitcoin or whatever if you sell a call, or you're paying 0.1 Bitcoin if you buy an option, right?
Yeah.
And so the collateral and the margin that you're using to trade these things is all crypto native. Yeah. But the strikes you're looking at are all dollar based, basically. So you're kind of thinking at those option payoffs that you're used to looking at, those hockey sticks are all like based on the dollar value of the asset that you're trading. But then the premium that's coming in and out of your account is all actually in Bitcoin denomination or Ethereum denomination. So that's what these inverse ones are. So because we're obviously now part of Coinbase and we are opening up hopefully to the entire US retail market at some point, it makes a lot of sense to bring linear options online so that, you know, people who are used to trading stock options, index options, whatever in US listed markets can just translate that way of thinking very easily to the way they trade crypto options. So it's all going to be margined in USDC on Deribit.
Which presumably brings like collateral efficiencies and stuff like that.
Yeah, I mean, it depends, right? Like there'll be certain native crypto players with large treasuries of digital assets that they're using options against, like yield enhancement type stuff. So they won't want to then switch everything to USDC and start trading those linear options. They'll actually want to keep themselves in the crypto and just sell the inverse options as they've been doing because it makes more sense for them.
Yeah.
And also people who've been on Deribit for many, many years, like me and you probably, if we've got a pot that we've built on Deribit over the last 5 years, to then switch it all to USDC would have tax implications, which we may not want. So it's more, I'd say it's more for new players who have not come into the crypto options space, and there's probably a whole load of them who want to. It's for those players to come in and make that transition a lot easier.
Yeah, if you're more like crypto native, like a miner, like and you're running hedge strategies around your say Bitcoin, then you're probably going to want to keep, you know, in inverse options.
Yeah, I mean, I think it's going to present some interesting sort of arbitrage opportunities as well between the two types of option. Also, there's smaller tick sizes and things like that.
Right, okay, yeah.
So that would be helpful for retail.
Yeah.
Obviously, one Bitcoin's now over 100 grand or whatever, right? Yeah. So, you know, lots of. I think it's just going to help growth.
Yeah, no, it's a great evolution, and it makes sense that you'd have these side by side and giving traders the option, no pun intended.
So I'm definitely excited to see what happens there.
Amazing.
All right. So tell us, what's the macro saying?
Joe, it was funny. You know, the English Premier League started back this week.
I saw the Liverpool game.
Yeah, and you know, the saying it's a game of two halves. When I think last week was a game of two halves, right, for the markets and for certainly for crypto, because we had Bitcoin hit new record highs above 124k, and then everything reversed. And there was two data points, right? We had CPI, consumer price inflation.
CPI,
yeah, it was kind of just like soft. Like even though core was sort of back up at 3.1%, headline was kind of flat at 2.7%. So again, no real signs of accelerating inflation, no real signs of sort of the tariff impact feeding through. So market rallied, Bitcoin hits new record highs, everything's pumping. And then on Thursday, we got the PPI, the Producer Price Index, which is kind of like essentially wholesale prices.
Yeah.
And that was blowout.
Because the tariffs have had impact there.
Yeah, and it's the worry as well with PPI is that, you know, if that's like what the, you know, businesses are having to pay, then how much they start to price on, so it can be seen as a bit of a lead into
how much they pass on to consumers.
Yeah,
so
depending on how much pricing power.
It's a leading indicator to CPI generally, right?
So it's just through a little bit more uncertainty around inflation, which has kind of been like niggling. It's the thing that's like niggling the Fed. I don't think, like my personal view on it, I don't think it changes too much for the Fed. Like we had like over 90% price for a September rate cut. That's now down at like
86, 84.
Yeah. So we're still like pretty much nailed on for a September cut. Obviously, we've got Jackson Hole at the end of this week. So again, I think there's a little bit of nervousness in the market.
Is that a risk, Jackson Hole? Because last time Powell spoke at the FOMC, he sounded very hawkish relative to what the market wanted to hear.
Yeah,
right?
I think like he's just, you know, trying to give himself some optionality around things. Look, I think Jackson Hole historically has been used to signal like changes in monetary policy and direction. There's no chance in my view that he's changing direction.
Sure.
He might sound a bit more hawkish in that, look, we can afford to be patient. Inflation's still, you know, above target. Economy's still sort of doing well. But we're not going to see that kind of paradigm shift in terms of, right, the Fed have signaled that they're changing direction. So I don't think it's a big deal, really. I don't think we're going to learn a lot new. However, it is quite a big risk event that a market that's feeling a little bit nervous is just going to take some chips off the table. And I think that's what we're seeing. So I don't think much has changed. The other big thing that I'm at pains to point out is the Fed for me at the moment isn't what's been driving risk in a way, which is why like equities are still like, you know,
equities are bulletproof, right?
Yeah. So, you know,
unbelievable.
We have, because I expect cuts keep getting pushed out because we're running fiscal deficits north of 6%, right? So we got the US are running like wartime level deficits still. You know, you're seeing Europe, Japan, China, they're all ramping up fiscal. You're seeing global liquidity still ramping up, pumping like global M2, all these measures of liquidity are still pumping. The dollar's still soft, which again is another tailwind for risk. So for me, the Fed isn't the game right now. So this knee jerk to our pricing around the Fed, I think gets very short lived because then we move on and go, do you know what? That's not what's been pumping this market in a way. So I'm not overly concerned around that. Look,
I saw a tweet. I think it was a response to one of my tweets, actually. Someone saying, because I was like, is this Bitcoin sell-off in the last few days that we've seen, is this leading equities in that, you know, risk sentiment might be turning here, but equities are still up there. There's like VIX expiration coming up tomorrow morning. Often that's like, that kind of makes the market a bit sticky. And then when that goes away, the market is free to move. Expirations have that impact on equities quite a lot. Is it a case of Bitcoin's leading us lower and equities are going to catch down? And like, what's driving this? Because normally there's a fairly high correlation there. Yeah. And then someone said that there's a TGA rebuild that's going on that Scott Besson has been talking about, and that's been draining liquidity from the system, and Bitcoin's reacting to that. What do you think about that? Yeah, so it's quite interesting actually. So you've got like the TGA, which is the Treasury General Account, which is like the Treasury's cash account really at the Fed. Yeah. So obviously since the debt ceiling got lifted, that was getting drawn down, and since the debt ceiling got lifted, they now look to rebuild that. Right, so they're issuing a lot of debt into the market, mainly through bills, and like they've got like over $1 trillion that they're going to issue this quarter. Right, it's a huge amount. So they issue that debt, people buy that debt, and that drains money out of the market that would otherwise go into risk assets.
Yeah. Now when they're raising that debt, when they're issuing debt, and then it's just getting spent in the economy, like net, it's like there's no impact. But when it's just going to sit in a cash account, they've taken it out of the market,
and it's not coming back.
It's not gone anywhere. So that's kind of a draining of liquidity. I think we're up to around 500 billion now in the TGA. I think they want to build it to around 600-700 billion.
I heard there was another 300 coming or something.
But the flip side is the RRP, the reverse repo facilities, been getting drained. Now just in August. Now that's again cash that's kept at the Fed by banks and predominantly money market funds. Now because you've got all this bill issuance, that money's coming out to buy, basically find like high yields in the Treasury bill market, like short term bond market. So that's been drawing down. Now that's down like around 200 billion just in the month of August so far. Okay. So I think that's been offsetting what we've seen on the rebuild on the TGA. However, we're now around like 30 odd billion on the RRP. Now, if you remember, we've spoken about this before. 2 years ago, that was over $2 trillion, the RRP, all that cash. And that's been, for me, been a big driver behind this this bull market that we've had. We're now down to the last 33 billion. Okay. Now, the problem is when that runs out, when that gets to zero, and you know, we talked about this, what I call Treasury QE, where Yellen started it and now Besant's doing the same, where all this debt issuance, they're front loading it by issuing T-bills instead of like longer dated securities. Yeah. They're doing all T-bills because it's easier, because it can fund that via the RRP and the money market funds. So it's an easier way of funding it. When that goes to zero, then you start to worry about, well, who's going to buy all the T-bills that you're issuing? Again, $1 trillion this quarter. Now, it's not immediate panic stations, because once that hits zero, then you've got banks that have excess reserves that they earn at the Fed. But again, commercial banks parking cash at the Fed, that they can then start coming in and actually sort of buying those T-bills. Okay. Right? So that's the next pool of liquidity. Now, the Fed themselves have said that in terms of what they sort of see as a comfortable level of reserves in the system, around $2.5 to $3 trillion. It's currently, excess reserves in the system is currently sat around $3 trillion. $3.3 trillion. So if you think of that, you know, they can get down to say 2.5 before the Fed would start to worry about it, or before it potentially causes problems. So we've probably got about another 800 billion that can come into the market.
These numbers are so big,
they're huge. Yeah. But what I do think is really interesting about it is when that starts to tap out, then essentially that's when you start to see the deficit, an exponential deficit, start to cause problems, because we've tapped out the RRP. Once we tap out the excess reserves, then who's going to buy these bills? And that's when you start to see funding issues and sort of front end rates start to spike higher. And if you remember in 2019, we had this repo crisis. Now, the Fed seem to be they've learned their lesson from 2019, I think. And that's partly why they started to taper QT, quantitative tightening. Now, I think this will cause them to now end quantitative tightening. The issue is, so ultimately, the Fed are going to have to start injecting liquidity and buying those bills when the excess reserves falls below those adequate levels. So we kind of, again, the long-term thesis for Bitcoin is, as soon as the Fed come in and start doing these operations, and by the way, every sell-side research is going to be arguing, well, it's not really QE, but it's going to be a monetary operation where they're injecting liquidity and essentially funding that deficit. You know, that's when Bitcoin's going to fly. The problem is there's a path to that. Right. And before we get to that path, you might start to see pressure on funding rates that start to sort of rise, and then things start to break before the Fed come in. So it depends how proactive the Fed are coming in. I do see there being a risk over the next few months where that starts to, that starts to cause things to break. Equities will get hit, Bitcoin and crypto gets hit until the Fed come in. And if I was to, on the assumption that the Fed will be a little bit late coming in, I think we've probably got like another 2-3 months of this bull market running. Then we hit those issues. we have a really decent correction in equities and crypto, then the Fed come in, and then we have that final hurrah that really takes us up. That would kind of be a mental map that I've got, but obviously that's there's a lot of moving parts to that.
Yeah.
But it's something to watch, but I don't think it's an issue right now. I think everyone's starting to be aware of it and talk about it. I still think there's plenty of liquidity in the system. I still think we've got like the lagged impact of the dollar. So I think what we're seeing right now in crypto is just, again, we're just consolidating off the highs. I don't, you know, we're in August. September's typically as well a seasonally sort of weak month for risk generally. Got a big risk event at the end of the week. I guess my message here is I just think we're consolidating. I don't think this bull market's finished yet. Just digesting a bit of supply, and I still think we take another leg up into like sort of November time.
Cool. And on the options side, I mean, we've had the pullback, but so far it's been relatively orderly, right? So we haven't seen a spike in realized vol. Bitcoin realized still around 30, ETH's around 60, it's kind of where they were last week. Implieds haven't really caught a massive bid. Ethereum's probably more bid than Bitcoin just because it had that big move up towards 4,800 and it quickly came back down. So just generally it's a bit more of a wingy sort of animal moving around.
No kind of signs of stress. However, you did tell me something about Bitcoin.
Yeah, so whilst the at the money vol hasn't done too much, what I'm quite keenly looking at is longer dated skew in Bitcoin, right? So, you know, I've been talking, whenever I talk about skew, you often hear me say, yeah, the market's correcting, short dated skew has flipped into puts, but the long end is still in calls. It's saying that this correction is a near-term correction, but longer term, we're all good.
Everyone wants to
own
the upside.
And I kind of suggested that I think longer dated skew is somewhat of a regime indicator that we're in a bull market regime still, right? In Bitcoin. Now, in the last week, we've started to see the entire skew curve going all the way out to 6 months, which is kind of where it ends in terms of liquidity. That's all come into put premium, right? Or it's kind of zero basically in the 6 month bucket, right? And last time it was here, it was like in the April sell-off, it was very briefly touched zero and then bounced off there, okay? So it didn't flip to puts, but it was kind of on the brink basically, right? And then we got that big bounce in April, right? So we're here again, but obviously we've barely corrected, right? So just by drifting down here from 123K to 115K, we're seeing the entire curve in Bitcoin head towards puts. And like I say, 3 month is already in put premium. It's only that 6 month that's kind of holding above zero right now, but it's pretty much on zero. So if that flips into like a couple of points of put premium, that's pretty much the options market calling time on this rally for now, right? And saying that actually the bullish regime in Bitcoin is kind of done. Ethereum kind of still does hold a call premium in the long end, but obviously Ethereum's chart looks very, very different and it's kind of woken, the beast has woken as it were in Ethereum because of all these treasury companies and how Wall Street is embracing stable coins and the Ethereum blockchain. So that's kind of probably got some room to run. But in terms of Bitcoin's dominance, in terms of Bitcoin driving the entire crypto cycle, the options market might be about to call time on it. So I think we need to watch that very carefully.
Interesting. That is interesting. That there are signs that some signs of exhaustion.
But it might also be. I mean, obviously, to counter my own argument, it might be that it's not necessarily a regime indicator. It's just that there's so much institutional money that's come into Bitcoin now, and it's kind of done. It's not like there's that much new institutional money that needs to buy Bitcoin that hasn't already done it. That the new money's coming into Ethereum, but the instos that are sitting on yards and yards of Bitcoin are now saying, well, maybe we should do what we do against our equity exposures and start hedging it, right? And do the trades that I do, like the risk reversals. And if there's a persistent risk reversal bid in Bitcoin, then that's going to start to move the skew permanently into puts like we see in equities. Yeah. And that might change the structure of the skew, basically.
So the regime change might not necessarily be indicative of
a bear market.
Of a bear market or a top in Bitcoin.
But just that they've done...
It might be a regime change in terms of the vol market and in terms of more institutions hedging.
Yeah, structurally higher put skew in Bitcoin because there's a need to hedge it because the allocations are so high now, basically, right?
Interesting.
Yeah.
Anyway, I believe you caught up with Gareth Soloway.
That's right. Yeah, so he's chief market strategist. And you know, he's a technical trader, and he's been looking at these charts. He's kind of a trend line based sort of technical prop trader. I had a good chat with him. And he's kind of echoing kind of what I'm saying, where we're at quite an important inflection point right now. Have a look at what he had to say. Hey everyone, welcome back to Crypto Options Unplugged. Today I've got a special guest, Gareth Soloway, Chief Market Strategist at Verified Investing. Welcome, Gareth.
Hey, thank you so much for having me. It's a pleasure to be here.
And it's a pleasure to have you. So before we kick off, why don't you tell everyone a little bit about your background in trading? I hear you've been trading for 26 odd years, pretty similar to myself. So where did it all begin?
Yeah, it all began a long time ago in high school, actually, in school where, I grew up in a family that didn't have much money. We were kind of middle, lower income. My family never invested, so I was never exposed to investing or making money in that way. And I kind of was looking, how do I get into a university? Like, what could go on my resume to get me like some money that they would give me so that I could go to one of these universities. And I found the investment club, and it was just in the late 90s when the dot-com bubble was forming. And I got involved. It was fake money, obviously, back then. It wasn't real money, and it was just kind of play money. But I saw the massive amounts of money that could be made, and it was honestly very addicting to think that you could put some money here and it would, double, triple. Now, listen. I think we've all learned that that's not the norm, but during bubbles, that is. And from that point on, I was so like infatuated by saying, I have to find this, I have to do this as a career, that's where I went from there. So that kind of took me into trading. I lost money like most traders do for multiple years, right? We've all been there. I still lose money occasionally. We all know that. It doesn't ever stop.
Oh my God. Someone admitting that they still lose money. Who would have thought it? Yeah.
There's no such thing as a perfect trader. The key is one thing I've learned is that if I look at the charts, I can get probabilities in my favor, and it's a probability game, right? And so you'll never be 100%, but I've been able to get my win rate up to like 75%, give or take. And as long as I don't take massive losses on those other small amounts, then I can be a profitable trader. And that's really been my story of just learning the charts, shutting off my brain, shutting off my heart. Don't think from your heart. Don't use emotion. Social media has killed us in that way where it triggers emotion. I shut that out. I look at the charts and I make the decision based on what the charts are saying.
Okay, so it's purely technical. There's no fundamental analysis or whatever. You're a chart guy. So, I mean, I've done a bit of charting in my life. It's not my sole kind of discipline that I use to make all my decisions, but it certainly is an input into my process. So there's the different things that people look at in charting, for example, right? Like there's supply and demand zones, right? There's trend, momentum and trend, that sort of thing. There's Elliott wave. Like, what is it within the charting world that you particularly gravitate towards?
So I'm basically a support and resistance trader. So I draw my trend lines on the charts. I take note of where things have been or where things found support in prior levels. And that's really what I'll trade over. So in general, I'm a counter trend trader. So I notice essentially a chart will tell me where emotion is getting overdone, right? In bubbles, they can go on for long periods of time, but when they hit key levels, you usually get a reversion. And so I'm looking for where the investing public has gotten too crazy. Their hopes and dreams have gotten way out of whack, and I'm looking for that reversion trade back down, and then vice versa. When everyone else is panicking and we're falling and they're just dumping, throwing the baby out with the bathwater, I'm looking for where is it going to hit technical support where we'll see a reversion trade where it starts to bounce back in the
mean reversion, not momentum following, not trend following.
Correct. Okay, the reason, and by the way, the reason why I'm not a big momentum guy is because, the trend is your friend until the end, but many of us have had the experience that we happen to buy right at the end of a trend and then it dumps out on us, right? And so I've really found my niche in this counter trend trading.
And what's your trading frequency? Are you trading intraday, like getting in and out every single day, or are you going a little bit longer?
Yeah, so I do day trade. So anywhere from seconds to minutes, even hours intraday. But then I also am a swing trader. I'm not really a big long-term investor, unless it's something like Bitcoin, where I do believe in the longer thesis, or gold, for instance, and I'm looking to offset, the decline in value of the US dollar. But really, it's holding for intraday or for weeks in general.
So your average holding period is like in the kind of weeks, not months and years.
Exactly.
Okay, fair enough. All right, that's good. I've got a better understanding of what your trading style is. Now let's talk a little bit about crypto. So when did you jump into crypto trading?
Yeah, so 2017, really when it started to kind of make waves, when it was making the bull market move, I started to really pay more attention to it. There was more volume coming in the crypto markets, and it started to become something that was very, very tradable. In general, it was a little harder to short back then, but over time now you have many, many exchanges where you can actually do shorting, which again is, a lot of people shy away from that in the crypto industry. Oh, I'm a hodler. But really for me, because I'm shorter term, you can make money on the upside and then you can make money on the downside too, and there's lots of opportunities there.
Where's the volatility you need, right? Like the whole point is because you're trading short frequency, the choppiness actually plays into your, your strengths, I guess, right?
That's right.
The more volatile something is, the more opportunities you'll get to churn in and out of it and scalp that money that a long-term investor who's just hodling he's not gonna capture any of that.
And that's a great point, is that, you give me a market there where price just grinds up little by little every single day. For a long-term investor, that's great. For me, there's nothing I can do with that. I need the volatility.
Okay. Right, let's drill a little bit into your views then, right? Because crypto's been quite interesting recently, right? We had a period of not too much, Bitcoin just leading the charge, dominating, the only thing going to the moon, everything else was like left behind. ETH was in the gutter, and my God, has that changed in the last month? Huh?
It really, really has. And it's interesting because Bitcoin is potentially showing us some weakness now. ETH again is pulling back, but Bitcoin is certainly looking like it's trying to break a key trend line. In fact, if you don't mind, I'll show my chart here. I'd love to do technical analysis on this here. Let me see here. Screens. We'll go right here and take a look. And so here's the Bitcoin daily chart. And again, in general, for swing trading, I'm focusing more on the daily chart. And what we do see is in technical analysis, this is called a double top. So you had a high pivot here, you reversed and came back in, you went up, and then this red candle was very telling, right? Anytime you have a green that's pretty big, but then the next one is even bigger on the reversal side, that's the dominant force in the chart. That tells you something is going on, and Bitcoin since then has come back in. Now, one of the things I'm watching very closely is this trend line here, right? So what we want to do is we want to take the low from April, which was the Liberation Day sell-off kind of lows, and we want to drag this trend line right up here. And so as a technician, what I'm watching very closely today is this candle right here. If it closes below, Bitcoin is very vulnerable for further downside. If they can rescue this and the daily closes back on or above, now it can actually rally maybe back higher. But really, again, this level right around 116,007 to 800, again, on a daily closing basis, I'm very cued in to what happens right here.
So let's say it fails. Then what kind of scenarios are we looking at in your mind?
Yeah, so you'd basically be breaking the uptrend that started in April. And so what that does is anytime you break a trend, aka trend line, it tells you that there's likely going to be more downside. Now, the downside, I'm not a big believer that Bitcoin's going to collapse, right? I mean, there's way too many people that are bullish. Institutions still are looking to get in. But what it tells me is that it might stair step down. And so, for instance, you have to look at past levels, right? So trend line tells me that this former low, which is this high as well, that's where we got the last bounce. That would be your next short-term move to about 111,700. And then again, it might bounce, but then because the uptrend has broken, it likely would eventually break lower, potentially retracing back to major support here at around 98,000. And 98,000 should be very, very solid support on Bitcoin. But again, in addition, you can also do your fibs. I use Fibonacci. I know you know what that is as well from being a trader for long periods of time. And from the April low, that would be almost a perfect 50% retrace. And so this is where I would start to inch in on a swing trade long right here, because I have multiple factors telling me there should be significant support.
And would you go short on a swing trade if we did close below that trend line imminent?
So I'm already short, so I'm already kind of exposed to that direction. But I would look to kind of continue to ride that to the downside. That would be right into the thesis of why I'm short Bitcoin at this point. And again, keep in mind, everyone gets so upset when I say I'm short Bitcoin. Remember, I'm a short-term trader, so like I'll be out and going long before people can blink an eye, right? And I think that's important to understand, is that my long-term thesis on Bitcoin is very, very bullish. I think it's a great asset as the digital gold, if you will, or something that we see the adoption of. But in the near term, I'm a trader, right? So I'm going to be going long and short 100 times over in the next
100%. 100%. I mean, it's funny you say that. People get angry when you say you're short. I mean, I tend to look at it from the sense that I'm hedged, I'm not short. So I own a certain amount of Bitcoin, and I'm like, depending on where we're at and how we're trading, I will be hedging some percentage of it, right? Exactly. Will that number be 25? Will that number be 50%? Will that number be 100%? To be honest, it's very rarely going to be 100%. I'm going to have to think, oh my God, we are in the horrible bear market of like 2022, for example, right? Where rates are getting jacked up, and it's the opposite of monetary debasement for a while, because inflation's on fire and they're just like fighting it with higher rates. But generally, because I'm a long-term bull as well, I want to ride that wave. But being the options trader that I am, I like to use options to help manage my drawdowns. So I'm very interested to hear what you're saying here, because right now I do have a hedge in place, and I have a rolling hedge in place pretty much all the time with half of my Bitcoin. And so I've got an option where I'm long the 110 puts and I'm funding them with the 125 calls right now. Okay. And we're sitting right in the middle. So if we take out 125, I'm basically taken out of half of my Bitcoin at 125, which I've made peace with. Right. But if we break down below 110, then I basically get short, and I've hedged out half of my Bitcoin completely, right? And that way I could stomach a drawdown to like 98K, like you're saying, and actually be in a great position to then monetize those hedges and then add more money and buy at those levels, right? So I feel like those hedges empower me to trade the volatility, a bit like what you're doing, but just using optionality, basically.
Yeah, and I think what you're saying is so smart, because, a lot of people are just all in and it's ride or die, right? But what you're doing is you're basically managing. Your money management techniques are very wise, because again, you don't want to see that big drawdown and you don't want to take that type of hit, so you can kind of maneuver and protect yourself, but yet still make money on the upside as well.
So let's look at the ETH chart, if you don't mind, because that's quite a different beast, right?
It sure is. It sure is. I mean, this has been an amazing run from the April lows, $1,400 to almost 4,800 here. Now, again, I was a little surprised at this. I expected us to at least touch the 4,800 Pierce level here and be just shy of that and have pulled back. And what I've noticed historically is that when that happens, it usually tries to fake people out and kind of whip them out of their long holdings before it actually does push up and pierce that level. And so essentially people were probably waiting to unload into that level, and it didn't do it. And now they're all unloading thinking, oh my goodness, I've got to take, some of this off the table. So what I'm looking at is, what I'm a big fan of is you're noticing the trend is strong into the upside. And so while I'm not going to buy up here, I would be a buyer on a retrace to the previous major high, right? So here we had a high going back to March of 2024, which then confirmed its validity in December of 2024. Here we broke out. And so ultimately, if we pull back to about 4,000, that actually should be a very buyable level for a bounce. Now, obviously, as a technician, if it breaks that, you want to stop out immediately. But as a short-term trader, I would buy this level because it's a previous major support level, or was resistance, now support. And that would be the next big move, where I actually think it should get above 5,000.
Yeah, that's really interesting. I mean, I didn't trade this one well. I'll hold my hands up. Like, I mean, I was just looking at that downtrend that had been in place for so long, and I was just not really a believer, right? I didn't really cotton on to the fact that these Ethereum Treasury companies that have popped up, the size that they're buying, in the speed that they're buying it, the market just didn't have the liquidity on the offer to basically give it to them, right? Because that's what it is. This is pure price impact of someone buying like $10 billion of ETH effectively, right? That's basically what it is, right? And it's just squeezed all the shorts, and it's just completely changed the way the chart looks. But the question is this an ongoing inflow now that's just going to keep coming for the next year or two, like we saw with Bitcoin when the instos started adopting Bitcoin into their holdings, like obviously Sailor being the biggest of those?
has this thing got a lot to run, or is it like, okay, they're filled in their size of 10 billion, 20 billion, whatever it is. They had a ridiculous amount of price impact, but now the market can kind of recouple again with Bitcoin, right? That's the thing that I'm struggling to figure out. And I think that's the million dollar question.
I would lean more towards that angle, and it's not to say that it won't over time go higher, but this dramatic of a move up probably does not continue with the velocity that it's going at this point. And again, I think you're right about that. There was a lot of negativity on ETH for a long time. We heard about how Solana was going to be the new ETH, and Ethereum's the old school thing, and then all of a sudden it flipped on a dime, like you're saying, and it caught everyone off guard. I certainly didn't participate with this whole move up either. There's no doubt about it. But I do think that, again, in the very least, it probably does pierce that high and maybe 5,000. But then I do worry that it might run out of steam and have a bigger corrective move. The biggest thing for me, and this is something with altcoins in general, including Ethereum, is that I do worry that the stock market, which again basically is at all-time highs in the US and many places around the world, if we do see a de-risking in those type of assets, it does tend to bleed into the altcoins inclusive of Ethereum. And so I think people just have to be a little bit, listen, it's not to say where it's going to be in 5 years. I have no clue in 5 years, but near term, I think there's a little bit more upside, maybe above 5,000. And then I'd be a little bit concerned once it gets there, especially if the stock market is topping out.
Yeah, it's an interesting one, right? Because Bitcoin decorrelated from equities, but ETH didn't, right? ETH had a higher beta to the NASDAQ than Bitcoin did. But recently, you could argue ETH is running on its own beat, basically, right? Because Bitcoin dominance has switched over to ETH dominance because of this new idiosyncratic factor that's driving Ethereum higher. Now, if that persists, right, that's the great. If that persists, then you could see a situation where NASDAQ sells off a bit, but the billion on the bid on ETH doesn't go away and just keeps taking it higher, right? I mean, it'll be interesting if we see that decoupling, but I wouldn't rule it out, just given the appetite that these guys seem to have to like ship in their Ethereum treasury at a very fast pace before everyone else starts doing it, right?
No, and you're right about that. As long as that appetite is there, the question is, we're and you know this from being at the trade desks, is that when the shorts are caught off guard, it creates these mammoth spikes. But once those shorts ultimately cover, the demand starts to wane a little bit. And again, the question will be, is there enough continued buying pressure to really drive it higher?
Yeah. Super interesting stuff. And then, lastly, like the other alts like Solana and stuff, that chart doesn't look too great, right? I mean,
no, you're right. It's stuck right now. And again, I have this bigger parallel channel that I've kind of been watching on Solana. And the question that I would have is there a rotation, right? We talk about with crypto, oftentimes you get rotations where Bitcoin's the hottest one, right? And then money comes out of Bitcoin and it goes to Ethereum, and then it goes from Ethereum to Solana. And so the question is, it hasn't performed well, but you could argue that that's the way ETH looked a couple months ago, and then we saw ETH take over. And so this is an interesting one where I wouldn't put it past it to make a spike up to maybe around the 280 to 300 level. Chart-wise, it's struggling here. If we go to the daily chart, there's a very obvious kind of zone right here that I'm watching, right? 205, 206 on Solana. If it can breach that, I actually think you could get that push up to around 280. So just something to watch there.
Yeah, no, I don't disagree. And maybe that coincides with the final blow-off move in Ethereum before it got a meaningful correction, right?
Yep.
Maybe that's true. What about the macro? Like you mentioned, you obviously look at the macro picture, you trade stocks and things like that. Now, like you said, stocks are at all-time highs and they just keep going higher and higher and higher. Like, what is it that you see on the macro horizon that could derail that? Because at the moment, the macro looks pretty good, right? Like even though, we saw a little bit of a crack in the jobs market, that just helped the market price in rate cuts sooner. You got Trump banging the drum for rate cuts. You got Powell on his way out. You got liquidity pumping. Most central banks are in cutting mode and they don't seem to care about inflation targets anymore, even if they're not admitting that openly. Like, what's going to derail this train?
Yeah, and I think part of it is there was a major offsides in the market, much like with Ethereum, but in the stock market, where once we heard about all these surprise kind of tariffs and how dramatic and how high they were, you had a lot of funds exiting positions, retail got out of positions, and now they've been playing catch up, right? And that's been driving the market up. Now, the one thing on the chart of the S&P, I have the S&P up here, you can see there's this amazing trend line going back to October 2023, which acted as support all along the way until it broke with that Liberation Day sell-off. And then look at where markets have come back. Right back to that line, it pulled back, and then here we hit it again, and it's kind of stalling out. So I'm really watching this trend line, which is right around 6,500 on the S&P, to see if it can break through, or do we start to cascade lower just a little bit? But going back to your question, for me, it's really watching to see when the economy weakens. And I think we saw the PPI data last week was a little bit on the hotter side, in fact, quite dramatically hotter. Maybe tariffs are starting to play an impact there on the producer side. And then the jobs data and the revisions were kind of eye-opening that the economy certainly could be weakening. So I don't think we're at a point where people are worrying about a recession yet, but I do think what derails this market is if we start to look like we're going towards recession, because then the Fed will be looked at as being late to the party, which they inevitably are, whether it's raising rates or cutting rates. They're always acting on past data. And I do think the markets would start to get very, very scared, as corporate profits would probably take a hit in a recession.
Yeah, I just wonder though, with so much room to cut rates, and so much political will to cut rates, like there's nothing stopping them doing a 50 bip cut, like out of the blue, if the data tells them to, right? So I think they would rather be late to the party to make sure the inflation is really dead. And then if they need to cut 75 in one go, they'll do it, right? And the market will scream higher on that because right?
I was going to say, do you think so my struggle that I'm dealing with right now is saying that, okay, yes, the Fed can cut 50 or 75, but number one, does that impact the long end of the bond market much, the 10-year, right? Because they don't have control over that. And that's what affects mortgage rates and all these other things. And then the other one would be, if we see inflation from the PPI data starting to filter into the consumer side, the CPI, let's say next month, does that handcuff the Fed from cutting as much as they might otherwise want?
Yeah, 100%. I mean, that is the risk. And the way I kind of see it playing out is probably more a case of, you see the data roll over, they do respond with aggressive cutting, but they do it before, but because of other structural things like the tariffs and that, inflation is stickier than it should be on an economy that's rolling over. So stagflation is raising its ugly head.
Yep.
They're trying to cut in a stagflationary market, and the long end of the bond curve says, that's not allowed. And that sells off really hard. And it's actually the bond market sell-off that takes the equities down hard. So equities don't go down too hard until bonds just really shit the bed, basically.
I think you're onto something there. I agree with you. I think that's going to be the shock to the market, is when you do get cuts and we don't see the bond market necessarily, at least the 10, the 20, and the 30-year really react like people hope.
And that even happened last week. That happened last week, right? We saw a CPI that was cooler. We saw the front end of the curve pricing more cuts, and the long end bonds were offered, right? Real yields were higher. So they're already showing you that that's the propensity that the curve has to move and steepen in that way. If the front end's going to get forced down for whatever reason, the back end's not necessarily going with it, right?
Yep. I think you're dead on that. And I think that's the case of where you start to see the market really freaking out in another sell-off that's not just 2% or 3%, but it could be 10, 20% in the S&P.
Yeah. It's tricky though, right? I mean, Bears have not had a good track record, right? I mean, it's been pretty hard to be shorting anything, in this market, right? The way things move, dips last like for an hour and you blink and you miss them. So you could argue, is it really worth fighting this thing? Or do we just say, okay, wait for the next dip and close your eyes and buy it? I think it's become reflexive. It's become a bit ludicrous that is just the trade that always works.
Yep.
But, if it ain't broke,
and You've traded long enough where you know this, and I remember 99, 2000 and what happened after. NASDAQ took 15 years to recover. And then what was interesting is once we got to COVID, you had this new influx of investors, right? People were working from home. They got checks, at least in the US, we got checks from the government. They were putting that money right into the market. They were saving more because you couldn't travel. And people have been conditioned that every dip is an immediate buy because the markets will see new all-time highs. And I've been around long enough to know that's not always the case. And I do worry that there's a rude awakening at some point for everyone out there where that doesn't work. And the question is, when is it? Is it a month? Is it a year from now? Where is it?
Yeah, exactly. And I think it's that FOMO that people are so scared to miss the next 20% that they're not willing to think, okay, look at where we are. Look at where names like Palantir are that have got a valuation of 140 times sales or something stupid like that. And if that's the world we're living in, when Fartcoin is ripping higher and it's like, it doesn't feel like very sensible, but it can go on for longer than, the bears can basically stay in the trade. So if you're going to be selling it, you got to find ways to sell it smart, not get carried out on the upside. Use optionality if you can. If you not understand options or you want to explore that is a great way to lean against the market when you think things are looking frothy. And that's what I try to teach people to do, basically.
I love that. I think so many people don't want to hedge because it caps their upside to some extent. But I'm telling people, like, there will be a reckoning day, and the people that hedge themselves will be the ones that still have their millions of dollars in their bank account versus other people.
Yeah, I think that's the problem. The people with $1 million definitely want to hedge. The people with 10 grand are like, I might as well,
baby.
Exactly. Roll the dice on a meme stock with no earnings and hope for the best.
Yeah. And by the way, just going back to, we started the interview talking about the history of myself. That was me for multiple years in the beginning. I didn't have much money. I literally had 10K to my name. I went to a prop firm. They gave me 50K to trade off of that 10K. And I would try to just bet it all on because I wanted to be super rich so fast. And every time I did that, I would pretty much lose, right? Maybe I can win every once in a while, but it was when I really started to be smart about it and diversify or protect myself that the real wealth started to build. And I think that's an important lesson everyone needs to know.
Amazing. I think we'll leave it with that because that's a very, very valuable point and a very valuable insight. Gareth, it's been a pleasure to meet you, and thanks so much for coming on the show.
Hey, thanks for having me. It's been a pleasure and great discussion. Have a wonderful day.
I'll speak to you soon. Cheers.
Yeah, so it's a good chat with Gareth, huh?
Yeah, interesting. I guess it kind of echoes what you've been saying around, a little bit of a dichotomy between the outlook for ETH versus Bitcoin.
Yeah, but he also showed the Solana chart where if we have a little pop above these levels, Solana could explode a quick 25% as well. Because I was like saying to him how if Ethereum does need to break the highs and go to 5,000, then is it going to drag things like Solana up with it? And that's like your last push before we get a more meaningful pullback, right? If Bitcoin's telling us there's a meaningful pullback coming, right?
Yeah.
It might be these alts want to have one final push.
Yeah.
And then we get it, right?
And I think, I guess, as we go hopefully this alt season gets more legs and we are seeing Bitcoin dominance continue to break down, you expect before we can kind of think about the top of this bull market for a more decent correction, you'll see that kind of blow off top in some of the alts.
Yeah.
I think now it's interesting, like just looking at some of his charts, like there are a few risks around at the moment. And I kind of think, we've had some really big moves. We're obviously digesting quite a lot of supply, which is natural when you have those big moves. There's a few risks around, but again, I think like my kind of closing thoughts remain that, I think the macro environment is still very supportive of further gains, not just for crypto, but for equities. But it's maybe a little bit of time, particularly into September, a little bit of time for caution.
Hedges, mate.
Yeah,
hedges.
Which is where like you say, your hedges and looking at ways to cheaply hedge.
This week, I rolled my August hedges into September, basically.
Yeah.
And because they were starting to decay away. And again, that's the risk when you're doing risk reversal hedges, is like you sit on them, the options just kind of decay against each other. So you don't lose any money. But then finally, the sell-off comes too close to expiry and you didn't have any protection.
Yeah.
Because you never made it through a put strike and it didn't do anything for you. So you've got to make sure that you roll them So there's enough duration on your hedges so that when the move comes, you actually get some explosion in vol, your puts get some value back in them, and then you can monetize them.
Yeah.
Yeah. All right. I think
Interesting times.
Yeah, I think we'll call it a day for this week. And remember, like and subscribe, and we'll catch you again here next week. Cheers.